Let's talk about something that holds a ton of people back from building wealth. This idea that you need a lot of money to even get started. Well, today, we're going to smash that myth. We're going to break down exactly how you can start investing with just $100. And spoiler alert, it is so much simpler than you probably think.
This isn't just a hypothetical question. I saw this on Reddit just the other day. A high school senior, super eager to start, had done all their homework, but was worried that the $100 they'd saved up just wasn't enough to get in the game. And you know what? That's a feeling a lot of us have had.
So let's just get it out of the way. The answer is a huge, loud, and clear yes. Not only is it possible, but it's probably one of the smartest things you can do for your future self. Honestly, the amount you start with matters way, way less than the simple fact that you're getting started.
But hold on. Before we jump headfirst into the stock market, we got to talk about step one, because every financial pro out there will tell you the same thing. You need to build a solid foundation first. Think of it like this. You wouldn't start climbing a mountain without checking your gear, right? Same idea here.
So before that $100 goes into an investment, make sure you've tackled these two things. High-interest debt, like from a credit card, is like trying to fill a bucket with a hole in it. It can drain your money faster than your investments can grow. And an emergency fund, that's your safety net. It's a bit of cash set aside so if your car breaks down, you don't have to panic sell your investments at the worst possible time. It's all about investing from a place of stability, not stress.
Okay, so you've got your basics covered. Your foundation is strong, so how in the world does $100 actually get you into the market? Well, the great news is that investing today is totally different than it was for our parents. We have these amazing tools that have just completely kicked down the old barriers. Let's look at the big three.
First up, something called fractional shares, and this is so cool. See, it used to be that if a single share of a company cost, say, $500, you needed $500, period. But now, fractional shares let you buy just a little slice of that share for $5, even for $1. All of a sudden, you can own a piece of the biggest, most exciting companies in the world, even with a small budget.
Next on the list is the ETF, which stands for Exchange Traded Fund. And for a beginner, this is a total game changer. Why? Because it gives you instant diversification. Instead of trying to find that one needle in a haystack, that one perfect stock, an ETF lets you buy a whole basket of them all at once. It's like going to the grocery store, and instead of buying every ingredient one by one, you just buy a complete meal kit. It's the simplest way to spread out your risk right from day one. And finally, for anyone who wants a set-it-and-forget-it kind of approach, there are robo-advisors. It's exactly what it sounds like. It's a service that asks you a few simple questions about your goals, what you're saving for, how comfortable you are with risk, and then it automatically builds and manages a diversified portfolio for you. It's like having a professional manager, but for a super low cost.
So you've got the tools, but where do you actually put them? Well, you'll usually start with one of two main types of accounts. On one hand, you've got your standard brokerage account. It's super flexible, great for any kind of goal. On the other hand, you have a Roth IRA. Now this one is specifically for retirement, and yeah, the rules are a little stricter, but it has one massive superpower level advantage. Your money grows tax-free, and when you take it out in retirement, also tax-free. I mean, that is a huge, huge deal over a few decades.
All right, we've covered the why, we've covered the what, now it's time for the how. What does it actually look like to take that $100 and make your very first investment? I promise you, you're going to be surprised by how simple this is.
And there you have it, 5 little steps. Tons of major brokerages now have 0 account minimums, so that's not a barrier. You can open an account right from your phone in like 10 minutes. You transfer your $100, search for a broad market ETF, something that tracks the whole market, like the S&P 500, and then you click Buy. And that's it. Boom! You are officially an investor. It's that easy.
Becoming an investor is a massive first step, for sure. But the real magic, the secret sauce, it isn't in that first $100. It's in what happens to that money when you give it the one thing it needs most: time.
You've probably heard this before, but it's worth hearing again, because it's at the heart of all of this. Compounding is when your investment earnings start to make their own earnings. It's like a tiny snowball at the top of a very, very long hill. As it rolls, it picks up more snow, getting bigger and bigger and moving faster and faster. Your biggest advantage as a new investor isn't money, it's time.
So, you might be thinking, why take the risk with stocks at all? Why not just stick my money in a safe savings account? Well, this chart right here is the answer. A savings account feels safe, sure, but look at those returns. A lot of the time, they don't even keep up with inflation, meaning your money is actually losing buying power. Stocks, on the other hand, have historically delivered much, much higher returns over the long haul. That's what gives your money the feel it needs to actually grow.
And this slide right here is the payoff. This is why we're talking about this. Let's say you invest just $100 a month for 30 years. Over that time, you'd have put in a total of about $36,000. But look what happens. With just a moderate historical return, that money could grow to nearly $100,000. And with a more optimistic return, over $300,000. Look at that. The money you actually put in is just a small piece of the final pie. The rest is pure growth. That is the magic of compounding.
Want a really quick way to feel the power of this? It's called the Rule of 72. It's a neat little mental math trick. You just take the number 72 and divide it by your expected annual return, and that tells you roughly how many years it'll take for your money to double. So, at a 6% return, your money doubles in about 12 years. But at 12%, it doubles in just 6 years. It's a simple way to see how even a small difference in your return can have a massive impact over time.
Now, here's the thing. Growing your wealth isn't just about stocks and bonds. The exact same principle, using small amounts of money for huge, long-term growth, applies to the most important asset you will ever have: you.
That same $100 can be a superpower in other parts of your life too. It can buy a few books that teach you a new skill that could literally increase your income for the rest of your life. It could pay for an online course. It could get you an hour of time with a mentor. And as one study even found, investing in experiences often brings way more lasting happiness than just buying more stuff. The principle is exactly the same. Small, consistent investments in yourself compound over time too.
So there we have it. We started with a simple question and ended up with a really powerful conclusion. $100 isn't just $100. It's a seed. It's a start. It's proof that you can do this. So the question is no longer if you can start investing, it's how you will. What's your first investment going to be?
Don't forget to subscribe to the channel, like the video, and click on the bell icon to turn on notifications.